like he introduced me, my name is Dako Puku Charles, and thank you all for joining us today for this important and thought-provoking session. I'll be the lead on this webinar on this interesting piece. And the simple question is, can you use your retirement savings as mortgage for a loan in Ghana's present situation? Now, let us leave this question unanswered. I believe as we move on, we will know if it is true or not. Now, before we start, I would like to start with a simple question. How many people are able to achieve the household dream, and how is it achieved? So the reality is, when you come to Ghana, it's only about 5% of our population who can independently acquire a home, and it's shockingly low. If you go elsewhere in the UK and the US, where there exists a strong mortgage market, mortgages form about 50 to 60% of their GDP. But if you come to Ghana, it's only about 0.78% of our GDP. That means the mortgage market barely exists in Ghana. And even across Africa, it's virtually insignificant. So because of that, many people in Ghana build incrementally. So sometimes it takes about 10 to 15 years to build or to complete a building. But here is the catch. That's a very long time to tie up capital in concrete. That is, if it takes you 10 years to 15 years, whilst you are building, you've tied up capital in the concrete, when that same money can be invested to earn returns elsewhere. Now, the next question is, how many people are able to live long to enjoy their pensions? If all these housing finance mechanisms are not working for us, the likes of mortgage, incremental housing, microfinances, and all that are not working perfectly for our system, then pensions can be a panacea. But then the question is, if pensions can be a panacea, then how many people live long enough to enjoy their pensions? Should pensions, retirement savings be substituted with home ownership or just having money in the bank? Now, if you look at a report by the World Bank, the life expectancy in Ghana is around 63.9 years. That means people have just 3 to 4 years after retirement at 60 to enjoy their pension money. So it means if you're able to live long, you're able to enjoy your pension money. But then with this statistics, it means that you'll be able to spend 3 to 4 years to enjoy your pensions. But what's even more concerning is if someone spends 15 years building a house, they might only get to live in it for a few years. That's 3 to 4. So if you go by the incremental housing finance mechanism, if it takes you 15 years to build, then you might only use 3 to 4 years to live in that house. Now, the interesting thing is pension can be a solution or a panacea to these problems, in that we can substitute pension funds or pension assets to acquire home ownership or to acquire a home to be able to achieve the household dream. Now, if you look at across the world how pensions are invested in housing, to provide context, pension investment in housing can be categorized into two models. That is the investment model and the end user model. So the focus of our discussion will be on the end user model. That's the demand side. So with the demand side, we have what you call the pension loans and the pension secured loans. So with the pension loans, if you are a contributor to a pension scheme, you are able to access loans from the scheme to acquire a mortgage or for housing finance purposes. That's with the pension loan. So directly you are giving the loan out of the scheme to be able to acquire a mortgage. Whereas there is the pension-backed mortgages, where a member only uses his pension assets as a collateral to acquire a mortgage. So in this model, you only use your retirement as a collateral. Now, so the focus of our discussion will be on pension-backed mortgages. Now, if you look at cases elsewhere in the world who have been using pension funds in their housing finance, you could see that if you take Singapore, for instance, their Central Provident Fund has been able to increase home ownership by 90%. So the Central Provident Fund, it's like a pension scheme where you can actually access your pension fund to access home ownership. And this mechanism in Singapore has increased their home ownership by 90%. If you go to Mexico, Mexico with the Infonavit and the FOVIS together managed to test of mortgage portfolio in Mexico. So these two institutions actually engage in pension asset financing, pension asset-backed financing, where you can actually use your pensions to access home ownership. And out of their mortgage portfolio, to test of it pension assets backed finance. Then if you go to Brazil, the Caixa Econômica Federal also is the biggest savings bank for low and lower middle income housing finance. So similarly, they also do pension assets financing there. And it has also increased, or majority of housing finance has been provided by this bank. That is the Caixa Econômica Federal. In our own context, that's Sub-Saharan Africa, countries like South Africa, Botswana, Namibia, Mauritius, Zambia, Kenya, and Tanzania have all brought up pension assets-backed mortgages. Now, this opportunity is also present in Ghana. Our National Pensions Act, that is the Act 766, after the reform in 2008, there was a section in the section 103, subsection 2, that incorporates this innovative feature that allows Ghanaians to be able to leverage their pensions to acquire or secure mortgages. Now, before we look at the specific challenges, okay, so although the provisions in the Act has provided that we can use our pensions to acquire mortgages, it has taken a very long time before products were designed. So the Act reform was in 2008, where the section 103, subsection 2 allowed pensions to be used as mortgages. It took about 30 years before products were developed. So then the question was, why did it take many years for banks to actually engage in the market? So EcoBank was the first to introduce a product in 2021, later followed by some other banks. So we wanted to find out why it took the banks or financial institutions so long to introduce products. So the objectives were, one, to investigate what innovations have come up since the inception of the National Pensions Act, and also what are the adoptions that have led to the slow adoption of pension-backed housing finance in Ghana, and the potential for the market expansion. Now, using interviews and surveys, we were able to engage about 17 banks and 16 registered pension trustees to get a full picture about how the whole pension asset mortgage market looks in Ghana. Now, it was found out that there are 3 banks that actually engage in the market. So like I mentioned earlier, the first product was introduced by EcoBank when it collaborated with Enterprise Trustees in 2021, where later Republic Bank also came into the market, followed by ABSA. And these are the products that they bought so far. So if you look at the slide, you realize that EcoBank offers a much broader home mortgage, especially through the Tier 2 and Tier 3 funds. So if I'm to give it context, Ghana operates a 3-tier pension scheme. So the Tier 1 is compulsory and managed by the state. The Tier 2 and 3 are managed by corporate trustees. So the law only allows the use of Tier 2 and Tier 3 only. So Tier 1 is exempted. So if you take EcoBank's pension-backed mortgage product, you are allowed to use your Tier 2 and Tier 3 funds and you can borrow up to the city equivalence of $350,000 with a loan term of 15 years. Now, what is interesting is the rate that is being charged on EcoBank's pension-backed mortgages. That is, it ranges from 18.5% to 19%, which is much lower than the traditional mortgages we know. So, if you look at Republic Bank's products too, they offer a dedicated pension-backed mortgage. With this one, you can only leverage your tier 3 fund, as opposed to the EcoBank that you can use your tier 2 and tier 3 to actually acquire a mortgage. So with the EcoBank's products, you can get up to 20 years. That is 20%. So relatively, it's higher than that of EcoBank. Hello, please, can you hear me?
Yeah, your line was breaking a little bit, but I think you're back now, so you can continue. You can proceed.
Okay. So if you take ABSA's product is quite expensive. That is, there's no disparity between ABSA's pension assets back mortgage and that of their traditional mortgages. It's a 26% fixed rate and a much higher amount you can borrow, up to 5 million Ghana cedis, with a similar loan term as compared to that of Republic Bank. That is a 20-year term. Now, one thing you should notice across board, all three options maintain a 50% payment to income ratio. And they all include similar related fees, such as consent fees, search fees, title processing. So if you compare pension-backed assets products to the traditional mortgages we know, then they are almost the same when it comes to fees. Because when you take traditional mortgages, you pay consent fees, you pay insurance, processing, and all that. So the only difference that can be noted here is the innovation around the pensions, that you can use your pension, specifically tier 2 and the tier 3, to actually access a mortgage, to serve as a collateral for a mortgage. And if you compare these pension-backed loans to traditional mortgages, you realize that traditional mortgages have a lot of variance. That is, with traditional mortgages, we have home purchase, we have home equity, we have home completion and construction finance. With pension-backed loans, there's only home purchase and short-term loans. Now, if you check the interest rates, you can see that pension assets backed loans or pension backed loans are relatively cheaper than traditional mortgages. It means it's good news. So if you are thinking of acquiring a mortgage, you can look at pension assets backed mortgages because they offer lower interest as compared to traditional mortgages. Their terms are quite similar. That is 20 years. That's on the average. If you take our traditional mortgages, you realize that they operate in foreign cities. So you go in there and buy a property or pay a mortgage at a foreign currency. Our pension-backed loans, since the pensions are operating in Ghana, then effectively they are also operated in cities. Then, like I said earlier, the fees are all applicable for both methods of mortgages. Now, after delving into the products or the innovations that have emerged since 2008, we wanted to find out why it took so long for the banks to respond. And we realized that there was high market risk. You see, the housing finance market is still volatile. Research has shown that even government securities that are termed risk-free are even subject to the vagaries of this economy. So lenders are sometimes cautious because of default, inflation that could arise when they used, actually pensions are actually pledged as collateral, because pensions are also investments. There's a portfolio where pensions invest in. So if the economy, if there's higher market risk, if there's higher inflation, you affect the value. Essentially, you affect the collateral value and it will affect the lending. So one factor that was identified was high market risk. And another factor was limited knowledge among the pension managers. So you realize that many trustees and fund managers lack expertise in real estate finance. So if you take the guidelines per the MPRA guidelines as to which investments trustees should invest in, then you realize that most investments are done in government securities. So little or less is done in housing. So it means that most of these trustees are a bit dicey about engaging in this market because their knowledge of the housing market is low. Now there's issue of low perceived collateral efficiency. So even before the Home Mortgage Finance Act was passed into bill, there was issue when it comes to foreclosure collateral. That's when someone defaults. Now this is a whole new product, pension assets. Now as it stands, there's no regulation as to how foreclosures should be done when it comes to someone using his pension as collateral for a loan. So then it also poses another risk. Will it be easy foreclosing pension asset as a collateral or not? Then the other issue was a small pension fund size. Now, if you realize our economy is dominated by informal sector workers, so it means that there's only a small portion of formal workers who actually contribute to pension funds. So the trustees and the banks don't see it as a viable venture to invest in. And there's limited pension coverage, quite related to the size. The coverage is also low. So the tier three, if you look at the banks, their products, some only leverage tier three. Then the tier three is voluntary. So it means not everyone, what's it called? Everyone invests or contribute to such scheme. So it means that the coverage of the tier three and the tier two is very small and limited. So again, it's not a good venture for the banks and trustees to invest in. Now, we wanted to find out if there's potential for the market because you realize that pension-backed mortgages are quite cheaper than traditional mortgages. So we wanted to find out if banks in the future are willing to engage in the market. And looking at the figures here, you realize that about 71% of the banks have plans to engage in the market. It means there's potential for the market to expand. But then, surprisingly, less of the trustees had plans to engage in the market. And it all boils down to issues of their inadequate knowledge of the housing market, collateral risk, and among other factors that were discussed earlier. But then, out of the 71% of banks that have engaged, that have plans to engage in the TDM market, 53% of them have actually explored partnership to design a product. So you realize that before product will be designed, it takes a collaboration between a bank or a financial institution and a trustee. Because here there are three parties involved here. There is a trustee, there is a bank, and the person going for the loan. So the trustee is the one taking care of the collateral, that's the pension assets. So before products will come out, it's always a collaboration between the bank and the trustee. Now, if you look at the number of trustees that want to actually engage in the market or have plans to engage in the market, it's only just 25%. But out of these 25, it's only 90% that have explored partnership to actually create products with banks to engage in the market. Despite this, at least 71% of the banks have plans to engage in the market. So it means it's a good deal for the future of the PBM market. That's the pension assets backed mortgage market. So thank you very much for your time and your attention. I'd love to hear your perspectives on how we can make this a reality in Ghana.
All right. Thank you very much, Charles. That is an insightful presentation, to be honest. A lot to pick from it. Um, this has been something that has been in the conversation for so long. I read several posts of Dr. Ken talking about it, and so it is it is so nice to come up close with the data. Talking about how it is impacting the market and the changes it's making. So I think your research is it's very relevant and particularly important to the conversations as we progress in this area. The floor is open for questions. But Charles, quickly, I have just noted a few things down. Um, you can also put on your video if you want. With respect to the rate that we are talking about, does it change? Um, I mean, is that like an average rate on the market, or it has specific it applies to specific individuals, and also does it work differently across sectors? Do people in the private sector have different rates? Do people in the public sector have different rates? In terms of the average rate you mentioned about between 18 and 26%, that variation, does it cut across as a form of industry the person is working in, or maybe the nature of their job or anything? Or I just want to know what makes up that rate.
Okay, so that's a great question. When it comes to the rate, it's fixed. So across all the products, from Absa to Republic to EcoBank, the rates are fixed. And irrespective of whether you're a formal sector worker or an informal sector worker, the rate, the same rate applies to all. I don't know if I was able to answer your question correctly.
So that means anybody who has a pension savings could get. I'm asking this because I know sometimes even in the block and mortar market, that sort of rate differentiate for specific people based on their risk profile, and that is why probably I'm asking if this also comes in for the pension backed mortgages. Yeah. Also, with the amount of you mentioned amount of $350,000 as what people could get, an amount people could get a loan up to. Um, will your endowment, as in your pension endowment as an individual, sort of impact this amount that you get? So if, for instance, um, my endowment is around, I think, let me just say 500,000 Ghana cedis. As at the time I'm going in for the loan, is that going to influence how much of the $350,000 I'm going to receive?
Yes. So how much you have accumulated in your pension
Yeah.
would determine the loan amount you get. So
Okay.
we find out that if you look at all the products that have been made, they are more of collateral enhancement. So most of the time, you see the contributions to these tier two and the tier three funds are very small. So, for instance, contributions to the tier two is just about 5.5% or 5%, and the tier three is actually voluntary. So you determine how much you put in there, and people don't really do voluntaries because the pension, the compulsory aspect, people are not even patronizing that well. So the amount in most pension schemes that's for the tier two and the tier three are very limited. So it means that you only use it to enhance a collateral you have already to actually acquire a mortgage.
Okay, so that means if a person has a land and the land is not up to the loan to value ratio of that land is not up to probably the amount the person needs to do whatever they have to do, then they can unlock their tier two and three pension contributions as a part of that land, and then they can get maybe a higher loan facility for whatever they want to do, right?
Sure, sure. So you can use the pension asset to enhance the land as a collateral. So it just becomes a collateral enhancer. Yeah.
Oh, that's interesting. All right, so the floor is open. If you have any question you want to ask, you are free to ask Charles as much questions as possible. We also have Doc here. If some of the questions you want to ask are maybe a little bit too technical, he can weigh in to give you a breakdown of that. But as it stands, if you have a question, you can use the chat. You can also use the reaction button. Just let me know, and then I'll call you in to contribute to the discussion. Doc, if you have anything you want to add to what Charles have presented so far, would also be glad to hear your thoughts on it.
I think it's a very good presentation. I just want to add a little bit to the collateral enhancement aspect. So I think for Ecobank, based on the publications I've seen in the media, they are now even offering a 100% loan to value ratio. You know, traditionally, banks, as part of their risk management, will usually not give you a 100% loan to value ratio. That is because when they give you, and of course, in the Ghanaian market, usually you find that people who are looking for mortgages are required to make some down payments, right? Usually between 20 to 25%, right? And so what that means is that your loan to value ratio is usually, let's say, up to about 80%, right? That is the maximum amount of loan a bank can give you. But then with these pension assets serving as collateral enhancements, now Ecobank is able to give you a 100% loan to value ratio. So this product, which is the pension-backed mortgages, one way or the other, has other benefits, which is that you don't need to make that down payment, right, to be this particular type of loan, so far as your pension assets are enough to cover the down payment requirement of the borrower. And so that is one of the advantages of the pension-backed mortgages. Yeah.
Wow, that's really interesting. I'm just wondering how many people out there have an idea of how this thing works. But before we advance the conversation, Hega has a question. Hega, you can unmute yourself and then tell us what your question is.
Okay. Thank you for the presentation. It's very enlightening. And I would like to, my question is in connection with the first question, one of the questions that Godwin asked with respect to the collateral enhancement. So let's say your tier 2 and tier 3 contributions are not enough to get the amount that the banks are willing to give to you. Can you negotiate with your pension trustees to kind of increase your contribution to enhance your chances of getting the amount you need for your mortgage?
That's an interesting question. Charles and Doc, if you have any response to that, we appreciate it. Yeah. Charles, you can go ahead. I think your mic is unmuted. You can go ahead and speak to that.
All right. So for a question, if I heard it clear, she was, can you increase the contribution rate so as to get a higher loan from the banks?
Yeah.
Was that your question?
Yes, I think that is the question. Whether you could negotiate with your bank to have your contributions increased. And then also, let me also just add a little bit to that. Also, is it possible for you to probably say, okay, your bank, the pension fund managers know that you are contributing to that pension fund, and maybe you have been consistent with it. Can you also negotiate with them so they can make provisions for an increment in your endowment, your pension endowment, so that you can use that as you can have a bigger pension endowment and then use that as your collateral for your loan. That is just to buttress what she asked at first as well. Yeah.
Okay. So let me answer your question first before you excuse me. It will depend on the scheme, the kind of scheme you are contributing to. So if there's any arrangement like that, you could make provisions where you can increase your contribution to get a higher loan amount. That is, you can, although you have a lesser amount in the pension, you can talk to them so that they can increase the actually negotiate with the banks for you to get a higher loan amount. But as to increasing the contribution rate, if you take the tier 2 and the Pensions Act, there is a stipulated amount you're supposed to put in there. That is 5%. So with the tier 2, you cannot actually increase the rates. That one there is your employer that pays that amount. But with the tier 3, since it's voluntary, there is a minimum amount you can put there, and you can actually increase. How much you want to put in there. So, for instance, for informal sector workers, you can contribute a minimum of 35% up to any amount you can afford. Yeah, thank you.
Okay, so I think I'd like to add to what Charles was saying. In fact, your tier 2 contributions can be increased. I think the maximum is up to about 16% or so. Yeah, so the 5.5 contribution you make is a minimum, sort of a standard, but you can actually increase that contribution to, I think, about 16%. I need to confirm that number, but that provision is there.
Okay. All right. Thank you very much. So you can, okay. So that is the response to you, Hagar. Okay. All right. So is there any other question that anybody has, any burning questions that you may want us to address here on this call today? Any question at all? Maybe you don't understand incremental housing and how this is coming to probably help people a little bit more to build faster. So all these are just to make sure that you are well secured in terms of your ability to put up your housing. There are many houses that have started. They have locked up, people's money have been locked up in it without they completing it, and it is terrible. Even at a government level, we are losing about $25 million every year to that. And I wonder how much the private sector or at the individual household level, how much we are losing every year due to uncompleted projects. And that must be an interesting research to look into. So these are all very important conversations for us to have. And you're welcome to ask as much questions as you can. Yeah. Okay, so I think someone is asking, please, isn't 100% loan to value ratio very risky, especially in the case where the borrower defaults? There is also another question here. Are these loans recourse or non-recourse? What does the law say? Or it depends on the banks and the type of agreement? Yeah, so those are two questions we have in the chat. Doug, I don't know if you want to weigh in on that, or Charles, any of you can weigh in on that.
Okay. Yeah, so is 100% loan to value ratio risky?
Yeah.
Yes, it is. But this is the advantage. You see, the pension assets are more liquid than real property. What that means is that in the event of a default, the banks can easily, let me put it this way, it should be possible, all things equal, for them to really convert those pension assets to cash immediately. right? Unlike property that will require a lot of marketing, to really realize the value thereof. Yeah. So in that light, it is risky, but it is not as risky as having property as collateral, right? And so I believe those are the considerations the banks made, particularly EcoBank made, in order to come up with such a product that allows them to offer 100% loan to value ratio. Is it recourse? Yeah, obviously. Every mortgage product is recourse. Yeah, so in the event of a default, the bank will take over the collateral to recover the outstanding loan balance.
Oh, interesting. Okay. I hope your questions have been addressed. Okay, so
No, Godwin, let me highlight this a little bit more.
okay.
The question regarding whether the contributions can be increased or not.
Okay.
Yes. So when you read section 112, subsections 1 to 5, and then sections 104, right? You are told, or it is written in the law, that a maximum of 16.5% and 35% of contributors' monthly income to be deductible for formal and informal sector contributors. So if you are in the formal sector, you can increase your monthly contributions from the 5.5% to 16.5%. And then if you are in the informal sector, you can do 35%. So that was what Charles was referring to. The workers in the formal sector are required to contribute to tier 1 and tier 2. So those are mandatory. Tier 3 is voluntary. If you work in the informal sector and you don't contribute to tier 1 and tier 2, you can still make provision for your pension by taking part in the voluntary tier 3 scheme. And if you are doing that, the act says that you can do a maximum of 35% contribution over there. Yeah, so those of you interested, you can look at sections 112, subsections 1 to 5, and then sections 104.
Thank you very much. Thank you very much. That has been insightful. Any more questions? All right. If there are no more questions, then maybe we can call this to a close. And I must say, this is particularly interesting for us to let me still highlight the fact that these things are important for us to be looking at. There are more things we'll be discussing, and you are always welcome to the people who have been consistent following most of the discussions we'll be having on the Ghana Property Forum. We can assure you that it's been getting better every time. And you are always welcome. If you have a research in the property industry, you can let us know. We'll look into it, look into your findings and the how much value it is to the industry, and then we'll get you onto the platform. All these things are recorded. We put them on our YouTube channel, Prop Intel LLC. You can find that on YouTube. Watch all the videos and gain some insights into how the property market works, acquiring properties, and also dealing with difficult people in the sector, surveyors, valuers, and everybody that you find in the industry. So you're always welcome to join us and enjoy all these presentations. Thank you so much. We appreciate your time here. Thank you.